Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 57 on April the 12th, 2019. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Intelsat, United States Steel, and IQIYI Inc. And then we discuss three new trades on PG&E Corporation, eBay, and General Electric. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. And I've also created a short video series to teach you all the basics of option trading that you'll need to know in order to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel for theweeklyoption.com. Now, last week we saw an increase in the Dow Jones Industrial Average and a slightly lower S&P. And the funny thing is, this week, we have the exact opposite. So the Dow Jones Industrial Average finished the week 12 points lower, closing at 26,412 points. The S&P 500 index grew nearly 75 points, ending the week at 2,907 points. So a little bit of an up move in the S&P, and certainly almost flat for the Dow, even though on a day-to-day basis, we did see some swings. Like the market, I believe today, the Dow Jones Industrial Average was up 269 points, which is an indicator that it was actually down for much of the week, or for part of the week. So that's that. Let's see. We're not going to be covering the earnings updates anymore, unless you guys email me and tell me that you like that. But I do track them on my own, just to make sure I don't get into anything crazy. Now, the topic for this week is risk. And risk is the most important thing to understand as a trader. In fact, some people think trading is simply about making decisions on how you're going to make money on your capital, how you're going to get a positive return on your capital. Trading, professional trading at least, good trading, starts with risk management. It starts with understanding what can cost you money and learning ways not to lose money. If you can figure out how not to lose money, you've got a much better shot at figuring out how to make money in these markets, right? So that's sort of where I'm starting from, and I wanted to make sure that we discuss, or that I at least discuss with you guys, the difference between limited risk versus unlimited risk in options. So just as a definition, when I talk about risk, I'm talking about the possibility of loss. And some loss is limited or capped, and some can be unlimited. An unlimited risk could actually cost you your entire portfolio, right? Whereas a limited risk is going to have a cap, or some sort of a limit to the amount of some sort of a barrier to the maximum amount of loss that you can experience. So when it comes to limited risk, some of the trades that are limited in risk are buying and selling spreads. So these credit spreads and debit spreads that we look at each week actually are limited in risk. And the thing that makes them limited in risk is that we have bought one option and sold one option. And that option, those spreads can never be worth more than the difference between the strikes. So if I sell a $1 option for 40 cents, or $1 option spread for 40 cents, the most I can ever lose on that is the difference between that $1 difference in the amount of money that I collected, which was 40 cents. So maximum loss would be 60 cents. That's a perfect example of a limited risk, because right from the start, my risk is limited. I can only lose that amount. Buying individual options, buying options is limited risk as well. When you buy an option, you can only lose the amount of money you paid for that option. That's it. If it ends up being a total loss, you only lose the money that you paid for the option. Um, Another one that's interesting is selling puts, and I don't talk about selling puts much on the show. That might be an area to look at as well, but selling puts can be great if you have a long-term um, belief in a stock. Selling puts is a great way to put yourself in a situation where you get paid premium today, but if the market falls, you're going to end up buying stock at a lower price. So let's say your goal is to buy Apple shares 20% below market. You could sell those puts today and just keep making money selling those puts each month, knowing that if the price drops down to that, you're actually going to be buying those shares. And as far as the margin requirement for selling puts is different too, because all you have to do is be able to cover the value of that stock if you need to buy it. So if you sell the 25 strike put, and we know that each option is worth 100 shares, it ends up being $25 times 100, which is $2,500. That's what it's going to cost you to buy that stock. And so that's what the margin requirements are. Again, limited risk. Trading any ratio put spreads that have you selling an extra naked or open put at the end is also limited risk. Now, when it comes to unlimited risk, things like selling calls, right? When you sell a call, it's different than selling a put because calls, in theory, can go up to infinity. So your brokerage is going to require a different size of account. A lot of brokers actually require you to have at least $100,000 in the account to sell naked call options. And that goes the same if you're selling ratio spreads that finish with an exposed unhedged call. When I say naked, I just mean unhedged. So if it has an unhedged open call that you've sold, that's the same scenario as just being short a call option. And then, of course, doing things like selling straddles and strangles because net you'll still be open on unhedged calls. So that's it for the topic of the week, our discussion on limited risk versus unlimited risk. Hopefully that gives you an idea of kind of what's really risky out there. So if you're only looking at taking limited risk trades, the spreads that I present on this show are a great option, as are buying single options, selling puts. And I don't discuss ratio spreads on this show, but it is something that I do quite a bit of in my own positions. If you're ever interested in that, you can email me and I'll tell you more about it. Or just email me at eric@theweeklyoption.com. Now, we'll get into the review of last week's trades, and we had a decent week in the markets. We'll start with the covered call on Intelsat. The symbol is I as in Isaac. Last week, the stock was trading for $17.52, and we looked at selling the April 18 call at 85 cents against owning that stock, hoping to collect a 7.5% return in 2 weeks. Well, this Intelsat stock rose $1.11 this week, and it closed at $18.63 per share. The April 18 call, which we sold, is now in the money, which is perfect. This trade expires in 5 days, so the plan at this point is to do nothing. As long as the Intelsat stock stays above $18 per share over the next week, we'll lock in the 7.5% return on our investment dollars. So what will happen is we keep the money we sold that call for. When the call expires in the money, they take the stock at $18 per share, and we bought the stock, of course, at $17.52 per share. So we lock in that 48 cents there as well. So not bad for a 2-week trade. I wish they all would end like that. That'd be fantastic. Next, we look at our credit spread. We did a credit spread on United States Steel, symbol X as in X-ray. At the time, the stock was trading for $19.84. And I looked at selling the April 20.5 call spread at 17 cents, which produces a maximum loss. Again, a limited risk, a maximum loss of 33 cents in 2 weeks. Well, United States Steel stock fell $3.10 this week, finishing at $16.74 per share. The call spread we sold is even more out of the money now, so at these levels, I would just hold on to the trade for a week and lock in the entire premium, that 17 cents, as profit. You might be able to find someone to buy this spread back for a penny, but I doubt it, especially with 1 week left to expiration. So just let it expire worthless, which is always our goal with these credit spreads. So no changes needed there as well. Our final trade from last week was on IQIYI Inc., symbol IQ, as in Isaac Quarter. The stock last week was trading for $23.48, and we looked at buying the April 24-23 half put spread for 32 cents, which leaves us with a maximum gain of 18 cents or 56.25% return in 2 weeks. IQIYI stock ended the week 22 cents higher, closing at $23.70 per share. The in the money put spread, which we bought, is now at the money, which means that 24 put is in the money, but the 23 half put is out of the money now. You could exit the spread right now for 22 cents, which would lock in a loss of 10 cents per spread. Now, one perspective on these debit spreads is that we are selling a lower strike to finance an in the money option. The April 24 put is still in the money by 30 cents. That means in reality, with stock right here, we've only lost 2 cents on the trade. Now, I'm not keen on exiting this position just yet. The stock appears to be consolidating in this region when I look at the stock chart. So you could either close this trade and take the 10 cents loss, or look to sell something against the loss. For instance, if you sold a lower put spread, it'll be fully hedged by the put spread that you own. So if you sold the 23-22 half put spread in April, which is only 1 week away, 1 week left, you could collect 8 cents, which just about covers your loss. Or you could sell the 23 half 23 put spread in April and collect 15 cents. And that's not too bad for a 1 week trade. So once again, there are ways to mitigate any possible loss when you're trading options, if you fully understand options, or just understand what other possible trades can be done around your position. So that's it for this week. We'll call it 2 wins or for last week, 2 wins and 1 loss that could be mitigated still, even with 1 week left. Now, of course, there's 1 week 1 week left in April expiration. This upcoming Friday, April the 19th, is April expiration. All trades in April at that point will expire. They'll either be in the money or out of the money, so they'll either trade for intrinsic value or they'll have a value of 0. So all our new trades this week are from May expiration. So let's dive into the new trades this week. So the first thing we're going to look at is a covered call on PG&E Corporation, the utility out in the West Coast. Symbol PCG, Paul, Charles, George. Stock ended the week at $23.08. And I'm looking at buying that stock and selling the May 24 call at $1.69, looking for an 11.3% return in 5 weeks. Now, you enter this trade by buying PG&E stock for $23.08 per share and selling the May 24 call at $1.69. This trade makes the most money if stock prices finish above $24 per share. Our second trade for the week is a credit spread on eBay, symbol EBAY, Edward, Bill, Adam, Yellow. Stock ended the week at $36.17 per share, and I'm looking at selling the May 37-38 call spread at 34 cents per spread, which leads to a maximum loss of 66 cents per spread. Now, you enter this trade by selling the May 37 call at 95 cents and buying the May 38 call for 61 cents. This is a credit spread because we are selling the spread. This trade makes the most money if stock prices stay below $37 per share. And then our final trade on the week is going to be a debit spread on General Electric, symbol GE, George Edward. Stock finished the week at $9 per share, and I'm looking at buying the May 10-9 put spread and paying 65 cents for that, which creates a maximum gain of 35 cents or 53.85% maximum return in 5 weeks. You enter this trade by buying the May 10 put for $1.16 and selling the May 9 put at 51 cents. This is a debit spread because we are buying the spread. And this trade makes the most money if stock prices stay below $9 per share. So that's it for this week's show. Feel free to reach out to me via email if you have any questions about any of the trades here or even about your own positions. And I try my best to get back to email pretty quickly. So I always love hearing from you guys. Thanks so much for listening. And if you like this podcast, share it with a friend. I'm absolutely happy to have my numbers grow so that we can reach more people. And I honestly am a full-on believer in trading options. But the professionals on Wall Street are using derivatives or using options to limit their risk. And I think more retail, more mom and pop investors should understand options as a means of offsetting any exposure that they have in the market, or just finding ways to make more money on their market, which is what I try to do every week. So that's it. If you have any questions, email me. Otherwise, have a fantastic weekend and a great week. Happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.